take a look at what is down in the market. It's not economically sensitive stuff. I mean, think about it. It's all the AI stuff that's getting hammered.
See, Brennan, Joe Calhoun, boy, are these fun times.
I
Yeah,
don't know if I call it fun.
you're both smiling. Uh,
What's that? What's that old Chinese saying? May you live in interesting times. It's actually not a Chinese saying, by the way.
my old business is at it again. We're hearing a lot of stuff in the media. They're really hammering the fall off in the market. People are concerned. And then that nasty word recession is coming up more and more than it has for a while. From the way you guys are reading it, Joe, let's start with you. What do you take from, not from the media, heaven forbid, what are you taking from the reports you're seeing?
Well, I actually think the market tells you something here. Markets always tell us something, right? It's a matter of whether you're willing to listen or not. So let's take a look at what is down in the market. It's not economically sensitive stuff. I mean, think about it. It's all the AI stuff that's getting hammered. Actually, if you look at the equal weight index, it's not down nearly as much as the cap weighted index because of exactly that. Most stocks are actually doing okay. It's the Mag 7 and the kind of the really high end growth stocks that are getting whacked. That's actually not something you would expect if you're headed for recession. In fact, in recession, when you're headed for recession, growth stocks tend to do better because their profits are not normally correlated or not highly correlated with the economic cycle. That's why they're called growth stocks. So actually, I think the market tells you right off the bat, just looking at what in the market is down and what is not down. I think it tells you already that this is not about recession. Like I think that the market was very expensive, in particular those Mag 7 and those really high growth stocks and tech stocks at the top of the market were very expensive. They had a big run, and it was a great excuse to take profits. Hey, we got a reason to take profits now because, and actually think about this too. The other obvious thing is that people are talking about is the tariffs. So, how exactly do steel tariffs affect NVIDIA? Yeah, I'm thinking probably not. Obviously, there are other things going on in the world with China in particular, with some changes in the chip industry that affect NVIDIA, but I don't think tariffs on Canada really have anything to do with it. Same thing with Microsoft, for instance. I don't think Microsoft's business is all that much affected by whatever happens with tariffs on Canada and Mexico. So I think that there's a lot of things going on in the market that people put it this way: the media is going to use whatever they think is the thing to lead with. If it leads, it bleeds, right? So
Hmm.
let's take this from a market correction, which by the way, we're not even in correction territory yet. Correction is a 10% drop, and those happen about every 18 months. They're just normal. That's what happens. But saying this is a normal pullback, that doesn't sell newspapers as they used to say, or it doesn't draw eyeballs as they say today. So oh my God, we're gonna have a recession. That would get some eyeballs. So I think that's what most of it is. Look, we've talked about this many, many times. We watch a bunch of indicators, and mostly we watch the market. But I mentioned one over the weekend too, my weekend update. Heavy truck sales. Heavy truck sales are a big deal. Those things are great indicators of how the economy is going. They almost always fall right before recession. Yeah, they're not falling right now, so certainly nothing there. And actually, that's one that could be affected, I suppose, by whatever goes on between Mexico, Canada, and the United States because of trucking, moving goods back and forth across those borders. So even that's not being affected yet. And of course, the data we have is from January. That was before a lot of this stuff. And I think that's another message too. We don't have a lot of data on February yet. The data we do have is not great. Some of the ISM surveys, some of the regional Fed surveys, they're not great. And we got an NFIB survey this morning, National Federation of Independent Business, kind of the small business survey. That confidence fell again last month, or yeah, in February. So that's not a great number either. But again, they're not recession stuff. The only thing I've seen so far that is recessionary is again kind of a survey. It is a survey, the Conference Board's Consumer Confidence Survey. The expectations component fell under 80, and an under 80 reading on that is generally associated with a recession coming, Not that it's here, but that it's coming. But then again, we had that signal a couple of years ago. It didn't work out. So these things are not infallible. I think focus on the market. Look, where are things right now? The 10-year Treasury note yield is essentially it's down from the peak in January when expectations for the Trump administration, I think, based primarily on the tax cut side, was very positive. But that's kind of taken a back seat now, and things have pulled back. But at 420, 426, I think right now on the 10-year, that's consistent with where it's been for the last 2 years. So nothing much has changed there. Same with the dollar. We're right around 104. Again, that's right in the middle of the range, maybe a little bit toward, yeah, right in the middle of the range, middle of the range of where we've been for the last couple of years. So again, not huge changes. Look, right now, this is the correction. That's all it is. And assuming that we don't, that we're not headed for recession, it's probably an opportunity to add to some things that you like. And other than that, it just really doesn't mean all that much.
You know, Steve, yesterday we talked about fear and greed. And generally, times like this is when people get hit with the jolt. And I'm not talking about the jobs report. You know, they see what Joe talked about. Suddenly, it's in the media, and they heard something from their barber, who got it from his cousin, who heard it from the plumber. Yeah, I mean, I think that's great advice. Look at the big picture. Let the market tell you what's going on. I rambled there, but oh well.
Yeah, I mean, I think the fear is an interesting point because, I mean, as much as it's a part of this, that the science that we'll look at things like heavy truck sales, we'll th look at things that's it's still, positive and doing well, like personal income or credit spreads that aren't signaling risk. There's a part of this that is a little bit more of an art side, a little bit more of a psychology side, and the fear sometimes comes into that of where you kind of put your finger up and see which way the wind is kind of blowing. This feels awful more like a correction to me than a bear market because typically, like a recession, a bear market, typically what you get is the greed's still out there. They're still buying the dips. There's still the excitement and stuff. I mean, we're not even 10% down. Generally, um, this just feels more like a correction. When you're starting to, have kind of the worry and the fear when you're not even down this much. A lot of times it signifies that you're closer to a bottom than really far away from it. But again, you got to follow the data. There is that kind of science aspect of this. But what the data's showing so far is, you had Goldman Sachs come out and say, hey, we're moving our GDP estimate for the year down from 2.4 to 1.7, and Morgan Stanley came out and said, hey, we're moving from 1.9 to 1.5. Oh, that don't make a good headline. Economic growth has come down some basis points. No, the great headline is a recession on the way. The economy's crashing, and so you build up this mania, you build up this excitement, and you get volatility and a lot of times overreactions. And I would say that is kind of what we're seeing more is the pot getting stirred. The media headlines getting out there, and when you look at the data, you've certainly seen a moderation in growth, and you've seen a moderation in growth from an economy that's not doesn't have super strong growth to begin with. um, but so far, that's really what we've seen here, is some moderation and the market reacting to that, and a lot of the stuff that had the most hype behind it actually being what's getting hit the most, not the areas you'd expect to be most impacted economic wise, as Joe pointed out.
Well, Joe and I remember, I don't think you've been in the business quite as long as we have, but when I got in the business, the Dow was at 800. We said if it ever goes over 1,000, wow. So a 600 point move today at 42,000 is not as big a deal as a 600 point move would have been when the Dow's at 800. With length of time comes wisdom, I guess.
Well, 87, I don't know if you remember that, but I think it was 587 points that day. And the Dow was around 2000. So that was a gigantic deal. We lost 20% in a day. Hopefully we can't do that again. Listen, it's interesting, the greed and fear thing. I remember, I think it was during 2008. I don't remember exactly when, but I had this client call me and he was just in a full-blown panic. And he's talking to me, and finally he goes, "Why aren't you more upset?" And I said, "Well, it's my job to not be upset." Listen, that's what people pay us for. We don't, listen, we've seen this stuff. A 10% correction. I do these things in my sleep. You get one of these, like I said, about every 18 months. They're just normal. And so you got to try to work on your emotions. Um, Listen, when everybody else is all panicky, that's when we want to be buyers. We're not really there yet. I will tell you, we're looking at stuff right now and saying, hey, where could we be a buyer here? What could we be looking at? I don't think we're quite there yet. I don't think there's not that panicky fear out there right now. Look, there's no doubt that we've seen a turn in sentiment to a much more negative than it was prior to, or say in December, for instance. Um, I'll give you one example of that is the American Association of Individual Investors has an investor sentiment poll that they run every week. They've been running this thing since, I don't know, 1970 something, I think. It's really old. And so it's been around a long time. That number hit 60% bears a couple last week. This week, I think it was 57. So around 60. Well, there's only been a handful of times in history when it got up to 60% bears, and all of them were associated with some kind of low. It is fascinating to me that we have a 60% bear reading in the American Association of Individual Investors poll that is higher than the bear number in the middle of COVID. Yeah, we got some high numbers in COVID, but they came like in April, May, June, and they were like in the 50s. I don't think we hit 60 at all during COVID. So you're telling me that right now people are more bearish than they were in March of 2000 or 2020? That seems a little crazy. We haven't seen so much in the market yet. I watch put call ratios very, very carefully. When you see people buying a lot of puts, and I mean just loading up, then you know you're getting close to a low. We're not quite there yet. There's been some put buying activity. We've seen the VIX go up. The VIX, we may have hit 30 this morning, but normally you got to get at least a 30 on the VIX to see a low. And really, if it's something more than just a casual correction, you might get 35 or 40. If it's a really dire situation, you're going 50, 60, 70, but I don't think we're headed for that. Look, just stay calm right now. I think that you got to try to not do what the crowd is doing. The crowd is kind of selling right now, so we're just not going to do that. Like I said, we're looking for some things potentially to buy. Haven't made any big firm decisions yet, but we're still looking at it. So I would just counsel everybody just to be calm and see how this plays out.
Well, on the other side of that, the greed side, I remember having a client come in for his annual review one year, and he looked at me and he said, "What do you mean? I only made 22% this year." So
Yeah.
anyway, so to the folks watching, this is a time to be calm. This is a time when you don't shoot from the hip with your investments. You need to have a strategy, and we do. So if you'd like to help us to help you with that strategy, let us know. Send us an email at info@alhambrapartners.com.